SME valuation multiples, science or witchcraft? Probably the answer is a bit of both. Generally, valuations are either going to be earnings-based, cash-based or asset-based valuations. Reality is the majority of SME valuations are earnings-based valuations. If you're doing an earnings-based valuation, then you will need to establish the maintainable earnings of the business, and you're going to need to establish the multiple or the capitalisation rate. When we talk about the multiple or the capitalisation rate, we're talking about the same thing. And that's where the challenge is for a lot of accountants in terms of coming up with that multiple. What we'd all like to have is some database, some reference point, some www where we can go that says here's the multiples for every conceivable industry or business sector. The bad news is it doesn't exist. The multiple or the capitalisation rate is a measure of risk of the business. We're talking about how risky is this earnings stream that the business is producing. And those risks are a mix of external risks and internal risks. Examples of external risks are sort of the economic conditions, the position in relation to currency, sort of what interest rates are going to be like. They're all factors of external risk that relate to the business. Internal risks are sort of risks that are quite specific. The client base, perhaps the dependency on a key client, perhaps the dependency on key people within the industry or the business, sort of the stage of the life cycle that the business is at. They're all internal risks, and what the valuer needs to do is to bring together, both identify the range of risks that are there, then bring those risks together to determine what the appropriate multiple should be. The problem we have is that unlike the public market you can go straight to the market, you've got an immediate reference point. The market on a daily basis is determining the risk position of a business. It's pricing the business on a daily basis. In the SME sector, there is no market like that. In some cases where you have a significant number of the same businesses in an industry, where there is a high level of activity in the buying and selling of those businesses and a level of public knowledge around that, then you do have some level of information. And in those cases, you may see that there are industry multiples or industry multipliers that are identified. But for many businesses out there in the SME sector, you just don't have that same spread, that same level of information. And you're going to need to then go back and find other reference points. And that really is what part of the work of the valuer is. It's part of the expertise that you're applying is to look at a business, look at what its risk profile looks like, understand where the broad range for the SME sector is going to be in terms of the multiple, and then by use of a series of reference points, you're going to be able to narrow that down to what is likely to be the most appropriate multiple for that business. What are those reference points? Well, that will vary a little bit from business to business. The more widely traded or the larger the number of industry participants are, the greater the likelihood is that you will have some reference to market information. From a valuation point of view, that's simply a comparable companies approach. You're looking at what other transactions have occurred. You have another reference point perhaps by looking at the public market. What are the multiples that public companies in that sector are being traded on? If you can identify the multiples that public companies are being traded on, and not one public company, but a broad basket of public companies, then you've actually got the ability to go back and discount the multiple or discount the rate back from what's occurring in the public market to the privately held market. As a general guide, you will find that privately held companies will trade on a multiple somewhere in the range of 20 to 40% of what's occurring in a listed market. There may also be some other reference points. You may be able to identify within a particular industry, sort of based on the life cycle of the industry, you may be able to identify elements of risk or lack of risk that exist. An example of lack of risk is if you're dealing with a business that has an annuity income stream. So it's not a transactional business. A transactional business, you need to hunt, kill and eat every day of the week. An annuity business is where you have built in either an ongoing revenue stream to that business, or you've built in a client base and a client cycle that just keeps coming back and has a certain predictability to their income. That's an example of a business that has a lower level of risk, and that lower level of risk helps to increase valuation multiples. As a general guide, you're going to find that SMEs sit somewhere in the range of 1 to 5 times. There are transactions that occur outside of that range, but in the same way that for a profitable SME business, in the same way that you wouldn't expect to see the multiple in the majority of cases being less than 1, you probably wouldn't expect it to be greater than 5. There tends to be a lot of activity in that 2.5 to 4 times range, but again, it's going back and looking at the quality of the earnings, the quality of the profitability, the quality of the drivers that go towards making up that business, and also what level of risk exposure it has. Higher the level of risk, the lower the multiple is going to be, because you're really saying sort of our riskiness of earning that money sort of is significantly less. The job for the valuer is to go out and find the reference points. Find the reference points, build the reference points, make a professional judgment. Once you've done that, you've got the pieces in place to an effective valuation.